Hey guys, Jordan from Precondo here. I wanted to do a quick video today on sort of the overall fundamentals for the Toronto housing market. I had a client ask for one recently and I realized the last one I did was in 2020. So I figured it's time to refilm this. If you are a subscriber of mine, you've probably seen some of these charts before. I've updated a lot of them. I've thrown some new ones together. So I apologize if you've seen some of this stuff before. But if you're not a subscriber, go ahead and do that now. And I'm going to hop over to my PC and we're going to go through this. All right, so first thing I want to do is zoom out a little bit here. And we go to the 26-year history here in Toronto for both condos and detached. So condos is the blue, purple line here. Detached is the orange line. And currently we are sitting at, and this is, by the way, guys, this is for Toronto proper, so in the 416, not the GTA. You look at the average price of a detached today in January of 2022, you're looking at $1.886 million. And the average price of a condo is at $760,000. So both of them at their all-time highs. And if you go back 26 years, 1996 through today, and you look at the average compounding annual, the annual appreciation, you got 6.92% for condos and 7.8% for detached. Obviously, you're not going to see that type of appreciation in many markets in North America, but certainly not for that sustained of a period. And we're going to talk about why I think that is. Now, I want to zoom out a little bit further because obviously everyone knows about the 1990s crash in Toronto, and no analysis of the market would be complete without bringing that into the picture, or at least in my view, it wouldn't be. So if you look at sort of the peak in 1999, right before things got really ugly really fast, we were at $273,000 average price, and this is for all housing types rolled into one. And then you kind of reach the bottom of the peak somewhere around here, somewhere around 1996. The market started to stabilize and trend back upwards. So when I build out my pro formas for pre-construction or resale condos, I like to use the 45-year average because it rolls in multiple crashes, right? It rolls in the 90s and it rolls in 2008, which we were largely sheltered from here in Canada. But it helps kind of give better context to, like, obviously you use a 26-year, we've had a really good 26 years. But ironically, you pull the 45-year and you still get a really healthy 6.61% appreciation annually. Now, here's the interesting part. If you're the worst at timing, right? If you time the market as poorly as somebody possibly could, and you purchased in 1989, right at the peak of it, at $273,700, and you held the property through to today, you'd be looking at 4.43% annually, which doesn't sound that good, but that's pretty much in line with most major metros over the last 20 years or so. So it's still very competitive. And also worth noting, on a property investment, you're probably levered 5 to 1, right? You probably only have 20% down on the property. So 4.43 multiplied by 5, suddenly the real return is much, much higher. When you compare a lot of the major metros in North America, and you look at Toronto versus areas like Chicago, Boston, San Francisco, New York City, Miami, LA, you'll notice that we have sort of a more stable growth period. Obviously, we weren't affected by either the peak or the valley following and preceding to 2008 and 2009 financial crisis. There are a number of reasons for that I won't get into here. I'm not a credit guy. I'm not a macro guy when it comes to economics like this. I'm not an expert in this stuff, but one of the large reasons we were so sheltered is simply because we didn't see the delinquency rise to the rate that the States did. Part of the reason for that was obviously we weren't giving ninja loans. We weren't giving no income, no job loans in Canada. Thank God for that. But the other reason that I think we did so well over the long-term period is because of the fact that we have been underbuilding relative to these other cities. And again, when you look at us on the worldwide scale, like I live in Toronto. I was raised in Hamilton. I have watched real estate prices my whole life, and Toronto has, at least in the last 5 or 10 years, gotten exponentially less affordable in a very, very quick way. And we've also gone from a position where 5 or 10 years ago, you could very easily get cash flow positive condos at 20% down to now you can't get that kind of yield, right? You buy a resale condo, 99 out of 100 of them are going to be yielding negative on the monthly cash flow with 20% down, even at today's low mortgage rates. And that's natural as a city becomes sort of more of a blue chip city, right? So as we become more of a noteworthy world-class city, you can only expect for property prices to rise faster than rental rates, and therefore you're going to drive down yield. But what's interesting is when you put it into context, we're really not that expensive on a worldwide chart here. And interestingly, too, we have the highest rental yield versus the price. So, you spend $1 million on property. In Toronto, on average, you get $39,000 a year in rent, which is, far better than areas like Hong Kong, London, New York, et cetera, that are only, sub 3% yields cash on cash. Now, this chart I have to update. I did not have time to update it. It is the median household income for Toronto, the entire Toronto, versus the median household income for all of New York, and then comparing that to sort of your prime real estate condos. So your downtown Toronto one-bedroom condo versus your Manhattan one-bedroom condo. In the Manhattan chart, I've ruled out co-ops, so I'm only using resale condos, which is really only half of their inventory, but to make things a little bit more fair. And then in downtown Toronto, we are using sort of CO1, so the core, the downtown district of Toronto. Now, like I said, this is 3 years old. So now we're hovering closer to a $700,000 median one-bedroom condo price, and Manhattan has seen a little bit of price growth as well. So rather than a 9x multiple, we're probably more 10 or 11x, and Manhattan's probably more like 17x. So it doesn't look as good as it used to look. And I'm not by any means trying to argue that Toronto is an affordable market. It isn't when you look at median income, but you have to keep in mind that if there is an income ceiling on property price, we aren't there yet. And then the other thing to keep in mind is homeownership rate is still very high in Toronto, right? We're still in the 60s. Areas like Manhattan are much, much lower. And again, this is just something you see in older, more mature markets like London and Manhattan, et cetera. You see a much lower home ownership rate as properties become less affordable to the average person and wealth consolidates upwards, right? More people have more investment properties and less people are able to break into the market. It's an unfortunate reality of a maturing market, but it is the reality. And that all leads to the inevitable question of, okay, so why are we doing so well, right? Why are we outperforming most other major metros in North America over the past 10 years for sure, and even over the past 20, 30 years? And the reason, in my view, right, well, number one, credit supply is a big driving factor of any housing market. I don't want to say that credit supply, low interest rates is not fueling this, but because of course it is. But we want to isolate the variables that apply to only Toronto, because obviously credit growth is and low interest rates is not a phenomenon specific to Toronto. In fact, it's available all over North America. So we want to just look at what's different here, what's driving the market in a different way here. And a big thing to me is our supply and demand fundamentals just don't make any sense. And I mean, we are underbuilding in a big, big way. It's easy to look at all of the cranes in Toronto and say we're overbuilding, but when you really look at immigration numbers, housing starts versus new population growth, you'll realize that we are underbuilding to a degree we never have before. So, for example, in the 2010 through 2020, we immigrated 800,000 more people than the previous year, but we built 300,000 fewer homes than the previous decade. Right? So immigration went up 800,000, housing completions went down 300,000. Obviously, that's going to fuel property prices. And just to drive this point home further, I pulled immigration in 2019 for the U.S. and immigration in 2019 for Canada, and did a quick little infographic here. So if you look at our population growth by immigration, it was 1.1%. The U.S. it was 0.18%. What's more interesting to me is the housing starts relative to that. So according to StatsCan and Fred, you have housing starts in Canada at 208,000, right? So we immigrated 437,000 people. We started 208,000 homes. In the U.S., they immigrated 595,000. They started 1.295 million homes. This chart doesn't account for birth rates either, but just at face value, that is a huge difference. And again, driving the point home further, you zoom out a little bit more and you go to 2005 through 2018, and you look at the average immigration per year versus the new housing starts per year in each country. You'll notice that on average, we immigrated 287,000 people and we started 187,000 new homes. In the US, they immigrated 1.175 million people and they started, get this, the exact same number of homes. So again, we have a shortfall of new housing starts. Now this data gets really interesting when you get a little bit more granular and you zoom in. So I had to do this one myself, so I had to pull some numbers and I'll explain where they all come from. So the first thing, we'll look top right here. So 2019 and in 2018, we saw a net population growth through immigration of 252,873 people. That is a lot of people for an area the size of the GTA and an area with the population of the GTA. Now, how many homes did we build? Well, we built 36,610 condos in that period, 13,260 townhomes, essentially, and 15,290 detached properties. In order to figure out how much housing supply that actually is, you have to figure out how many people live in each type of property. So based on the Toronto census, we have on average 2 people per dwelling in a condo, 3.06 per dwelling in a townhome, and 2.72 in a detached. So over those 2-year period, we built enough condos to house 73,220 people. at the current persons per household number. We built enough townhomes for 40,576 people, and we built enough detached for 41,589 people. So in total, we built enough housing for 155,385 people, which is actually quite incredible. Obviously, you need a ton of labor force and a ton of cranes and all kinds of stuff to make that, to even reach those sort of numbers. But we saw population grow by 100,000 people more than the population would have supported through the new housing completions. So we had a deficit of about 38,381. So we built 38,000 homes too few in just a 2-year period, right? And you can tell like this is a problem that we've been seeing for over a decade now. Now, obviously, we've increased immigration targets, right? So immigration targets are going up. 2021, we were able to hit that 401,000 target, I believe, but a lot of that was just shifting people waiting for their PR to, anyways, a lot of it was just people that already lived in Canada, giving them their PR and citizenship. But regardless, 2022's target is 411,000 people. I believe we're going to achieve this. We're just going to lower our CRS scores. And hopefully we target skilled labor. And I'll tell you why later, but we really need people who know how to build properties. And then 2023, the target is 421,000 people. Obviously, the share of immigration that's coming to the GTA, coming to the Toronto CMA, is higher than it's ever been. You're at 34%. Now, if you were to extend this chart into 2020 and 2021, obviously because of COVID, you'll see that we had an exodus of people from from Toronto. So maybe there's an argument to be made that we're not going to see 34% share of all immigration land in Toronto anymore. But I think we'll definitely land in the high 20s, low 30s as downtown starts to open up. And again, that's where the opportunity is for a lot of new immigrants. So you even see it with the RNIP, the Rural and North Immigration Pilot, where basically the city or the government gives immigrants incentives to move to areas like, I believe Thunder Bay is on the list, Timmins is on the list. Anyways, what you see is after the 2-year stint or whatever it is you have to fulfill your obligations, a lot of them end up in areas like Vancouver and Toronto anyways, because that's naturally where people want to immigrate to. So population growth in Ontario, you're looking at 10.2 million people by 2046. And of course, our 100-year goal in Canada is a population target of 100 million. I have no idea if that's even feasible. So you have all these new people coming to the country and, we're not building enough homes. We cannot seem to complete more than 30 to 40,000 homes a year. That seems to be about where we cap out. Just labor, material, developers. That seems to be about where we cap out. So despite the fact that immigration has been increasing over the last couple of decades, you don't really see in Toronto and in the GTA specifically, you don't really see much of an increase. Now you do see a bit of a trend upwards in Toronto. And that's because obviously in Toronto, it's you're delivering far more condos, higher market share of condos than of detached or freehold properties in general. So it's going to be easier to deliver more homes, but we're running into some issues on the supply side of condos in terms of cost of construction that I'll get into a little bit later. So those are just the supply and demand fundamentals. Like I said, credit supply is obviously a massive part of the housing market, but I'm trying to isolate for just Toronto what is different about Toronto specifically. So we're not going to talk about here. There are better people on YouTube to follow for macro thesis. You can follow Steve Soretsky. There are a few other people as well that are great to follow for that. So let's talk about the current market. What do things look like today? Well, obviously, September 2019 through September of 2021, or what we could call almost the COVID market, we saw exurbs, right? So suburbs that are relatively far outside of Toronto, really run in price because obviously people were leaving downtown, they were working from home, they needed more space. And so suddenly the exurbs markets and even rural markets became incredibly hot. So if you look at the 2-year price growth from September of 19 to September of 2021, you notice that, Mississauga detached are up 39%. London is up 60%. Kitchener-Waterloo, 55%. Niagara, 57%. By the way, these are up even more now, right? The run hasn't stopped yet. GTA in general, as a sort of benchmark, you're looking at 40% growth over 2 years. Then you zoom into condos and you look at Toronto. This is the 416 as a whole. We're up 16.7%. Now we had dipped for a while, right? So condos were selling for below their peak for a little bit, but we've made up for that and a little bit more since then. CO1 specifically, the worst performer. So you look at the downtown core specifically, the worst performer. Again, if you look today versus September of 2021, you'll notice that there's been huge price growth in CO1. maybe not huge, but an additional 10 or so % on top of that. So things are recovering relatively quickly. And if you watch my previous videos, you know I've been predicting this for quite some time. But this just goes to show like these exurb markets are incredibly frothy. They're selling at valuations, 50 to 70% more than they would have been just a few years ago. So why is this happening? Again, this is not anomalous. Toronto is not the only place experiencing this, right? Vancouver is seeing this. Areas like Kelowna, Chilliwack are seeing huge price growth, right? You look at areas in the States, they're seeing the same thing, right? So again, lowest interest rates we've ever seen. Work from home, driving a buying frenzy in areas that were less desirable previously, but now more affordable for more space. So suddenly become very attractive options. And then a big part of it is just there's no inventory, right? So if you look at the active real estate listings on the market as a percentage of population, credit to Z-Line on Twitter for sharing this, because it is just an awesome chart. You can see that back in the 90s, early 2000s, we averaged 0.4 to 0.5 percent listings as a percent of population active on the market. Currently, we're below 0.1%, which is, you're talking 1/3 the inventory that we normally see on the market. And even you just go back a few years and we're averaging 0.3 to 0.4. So again, 1/3 what we normally see on the market. And one of the more interesting indicators to me, and one that I've been watching very closely, is the average price of a detached versus the average price of a condo in the 416 and the price difference between the two. Because in the 2016 and 2017 detached run-up, it was sort of the first signal that condos were going to run. Of course, most people ignored this, and detached was sentiment was detached was where the value is. And so condos were kind of lagging detached appreciation. And we got to this place where the average detached price was $1 million more than the average condo price in Toronto. And then of course, the stress test came, the non-resident speculation tax came, and we saw it correct to a more normal $700,000 price gap between the two different types of assets, condos and detached. Well, because of COVID, we're right back to where we were in 2017. The current, in fact, we're even higher. So the current difference between a detached and a condo property is $1.125 million. This is important to me because at $1.88 million, the average price of a detached in the 416 right now, very few first-time home buyers have the level of income, never mind the down payment, to support that. So unless they have help from the bank of mom and dad to supply that down payment and also really high incomes to support that mortgage, it's very hard to justify those property prices. So one of two things happens. They either take a bet on work from home for forever and they drive till they qualify, or number two is they buy a condo because it's such a good deal relative. And of course, that's something we saw in 2017. People suddenly realized, wow, these condos are really cheap relative to detached homes. And we are right back there again. Months of inventory is my favorite indicator to watch for short-term market outlooks, right? So if you're not familiar, months of inventory is very simple. It is the number of listings currently active on a market divided by the number of sales in any given month, right? So if you have 1,000 listings on the market and you have 500 sales in a month, you have 2 months of inventory, meaning that ostensibly, if no new listings came to market, everything would sell out in 2 months because that's your current run rate of property selling per month. Anything below 3 months of inventory is considered a seller's market. Anything below 2 months of inventory is considered a very aggressive seller's market. Anything above 5 months of inventory is a buyer's market. And anything between that 3 and 5 months of inventory is a sort of balanced market where you want to see things for sort of a healthy buyers and sellers market. This is the average price of a Toronto condo versus the months of inventory. And I like to show this chart because it really gives an example of seeing months of inventory lead the market in a very short window, so you can see where things are headed. And you notice that in 2016 and 2017, detached properties ran aggressively, right? We're right here where detached were super expensive relative to condos. And then condos were sitting in the balanced market at about 3.5 months of inventory. And then abruptly they crashed, right? So they crashed to below 1 month of inventory, and we saw the hottest sellers market on record ever. We saw, 15, 20, 30% appreciation on some condos in 2017 through 2018, right? And you can kind of see that the price spikes as MOI dips. And then you can kind of see we stayed in a seller's market, somewhere between 1.5 and 2 months of inventory for some time. And then things were heating up again at the start of 2020, very reminiscent actually of the start of 2017, and it was multiple, condos were all getting multiple offers. And then of course, COVID really took the wind out of the sails. We see months of inventory spike abruptly to well into a balanced market territory. And of course, we see prices, as they were getting quite frothy, start to correct and pull back a little bit. And then condos dipped anywhere from 10 to 12, even 15% for a little bit. So you could get some really good discounts. And then of course, now we've since made up for that loss and then some. So condos are up between 10 and 20%, depending on the neighborhood that you're looking at. It's really, even depending on the building. So market's very fragmented right now. Some buildings are absolutely ripping, some are not. But yeah, somewhere between 10, 15, 20% from previous peaks. So here's a months of inventory chart for detached versus condos. So the orange line here is the months of inventory for detached, and the blue line is months of inventory for condos. So like you can see, detached was the hotter property in 2016. Detached was the hotter property in 2016. And then of course, condos came and dipped below them, and condos entered a seller's market, and detached hovered around a buyer's market, loose seller's market for a little bit. And then COVID came into play, an abrupt spike in months of inventory as buyers sort of clammed up. Nobody knew what to do. COVID lockdowns were here. Nobody really knew what they wanted to do. Then work from home started. Everybody realized, okay, I want more space. And so you see just the months of inventory for detached properties plummet, and condos hover up in balanced market territory for some time. And now what we're seeing is a little bit of a reversal. I probably should have made this chart bigger, so I apologize. But if you can see that there, you can see that right now, as of January, for the first time in a long time, condo months of inventory is now lower than freehold months of inventory in Toronto. And just to give you guys perspective, because a lot of the time, like, people don't realize how crazy it is that Toronto's been sitting for 5 years below 2 months of inventory. In Miami, their condo supply has been averaging between 10 and 14 months of inventory for a number of years. And because of COVID and Miami being one of the places that, has the least strict lockdowns and all the rest of it, and their market doing incredibly well, even today, right, they're sitting, or at least towards the end of 2020, they're sitting north of 7 months of inventory. Manhattan, right, average over the short term, 16 months of inventory. Average over the long term, 7 months of inventory. So again, 2 months of inventory is incredibly thin. So again, it kind of drives the point home that credit supply drives a market. Absolutely. I'm not denying that. And if we see 6, 8 rate hikes, we're going to see some of the froth pulled out of the market. We're going to see some corrections, especially in overly frothy areas. I'd be worried to be buying something in Bancroft at a 90% increase over 2 years ago value when rate hikes come into play. I would rather hold something like a condo, which in my view is slightly undervalued relative to the other options out there. So let's talk briefly about market dislocation, right? So I obviously already talked about detached homes versus condos downtown, but it's also about suburbs and exurbs versus Toronto. So if you look at the price of a Toronto detached versus a Whitby detached over the last, going back to 1996 through today, this is a ratio, right? So essentially, if you go back here, we're sitting at 1.5. So back in 1996, the price of a detached property in Toronto was 1.5x the average price of a detached in Whitby. And then you look over the years, that continued to trend up until a peak of about 1.9 to 2x. So meaning that the average Toronto detached was worth about twice what the average Whitby detached was worth. Now, you might say that in and of itself looks like kind of a market dislocation, right? I tend to disagree because there is no more land in Toronto in the 416 for detached properties. So you only see condos being built now. There's a land scarcity element. So naturally, where there is no more land to build detached homes, you're going to see appreciation a little bit quicker there than areas like Whitby, where they can continue sprawling because there's so much land available to them. Then, of course, COVID enters the market, and you just see the ratio detached. So the detached ratio plummet. So currently, we're trading at 1.4x. So currently, a Toronto detached is only 1.4x the price of a Whitby detached, which again is just absolutely crazy to me. Now, we're also seeing dislocation in condos across different neighborhoods, right? So here's a condo in Square One in Mississauga. This is on the resale market, 575 square foot, 1 bedroom, just sold for $740,000. That's $1,287 per square foot. There are very few buildings in downtown Toronto that you can't buy at $1,287 a foot. So it's incredible to me to see that today some people are willing to pay the same price or even a little bit more for a condo in Square One than a similar condo downtown. And again, that just to me signals market dislocation. There's no way that a condo in Square One should in any rational market be worth more than a condo downtown. Because work from home doesn't change. You still have the same amount of space, but you're paying more for it in an area like Square One versus downtown. Again, doesn't make a whole lot of sense to me. Here's another one. This one's up in North York, a 1-bed and den in North York, selling for $938,000, working out to over $1,300 a foot. Now it is on Yonge, so it has transit, so you can get downtown relatively quickly. But look, again, $1,300 a foot. You can just go ahead and buy downtown for $1,300 a foot or less. And another example, you've got 15 Waterwalk up in Markham, Highway 7 in Warden. You've got this one here, 649 square feet, sold for $820. There was a recent one that was 699 square feet, sold for over $900K. So you're talking, $1,200, $1,300 a square foot in Markham. So now that we've talked about just sort of the big picture and then zoomed into today's market, I kind of want to talk about pre-construction. Obviously, this is a pre-construction condo channel. So why pre-construction as an investment vehicle? Most of us go to a job, right? Most of us have a job where we expend skills and time in exchange for an income. So we expend calories in exchange for money. We spend most of that on necessities. We have some left over to invest. And the goal for me, and I think I can safely say for most people, whether we're investing in stocks, real estate, crypto, Dogecoin, whatever the case is, our goal when we're investing that money, right, is to make sure that the risk reward makes sense. And also the ultimate end goal is to reach escape velocity as safely or as quickly as possible, right, with a high strike rate. So what do I mean by that? I mean, escape velocity, get to a place where your income from investments or the equity in said investments vastly outnumbers the amount of money you need to live on. So you don't have to work anymore if you don't want to. You can spend time, with your kids. You can spend time on a boat, fishing all day. Like, it doesn't matter. Whatever makes you happy. That's what escape velocity. That's what we're all chasing. In other words, I guess retirement, right, is what most normal people call it. Now, there's a great quote from Andrew Carnegie. 90% of all millionaires became so through owning real estate. I don't know how true that quote is. I don't know, in Canada, it's probably pretty true because, in Canada, as of 2018, we had 1.3 million millionaires and 60 or 70% of that wealth was tied up in real estate. So a vast majority anyways, putting that aside, I would say if that quote's not true, I think you can extend the quote a little bit and just say 90% of millionaires became so through obtaining equity. Now, for a lot of us, that's equity in real estate, but it can also be equity in stocks or equity in a business that you build. Now, most of us don't build businesses. We have a job, so that rules out that. And you're stuck with, crypto, stocks, real estate. So if we look at the past returns for pre-construction specifically, and pre-construction is an interesting one because generally when you buy pre-construction, you're paying a little bit more than resale market value, right? We'll talk about that shortly, but generally that's just the case. You're paying 10 or 20% more than a resale condo on the market today. If we look at the newly registered condo investment units, and this is a report from Urban Nation and CIBC, in 2020, which was of course a bad time to close on a condo, right in the heart of COVID, you'll see that the average purchase price was $415,175, and the average value at closing, at appraisal, was $595. So the average person was up 43% on their investment. And of course, that was a levered investment because generally speaking, most of these people would only have 20% down on those properties. So put $83,000 down on a property, you make $180,000 in equity by the time of closing. Pretty good deal. Here's an example at the Duke Condos in the Junction. Great little boutique build here. This one was purchased in 2014 for $551,000. You would have put 20% down plus closing costs, so you'd be like $138,000 to $140,000 into this deal. It was then sold in 2021 for $1 million. So you're looking at a $450,000 gain over that period. So about 8.9% year over year. But of course, you're levered. So when you count for your 5-to-1 leverage on the property, suddenly it gets a lot better. You're looking at 20.55% year over year on down payment plus closing costs. Another quick example, Eau de Soleil was purchased for $526,000 in 2014 or 2015, and then it was sold for $925,000 in 2021. So 75% value gain over 7 years, or 8.4% per year. Another example, Hill and Dale. This one was purchased for $2.789 million. It was then sold in 2020, 4 years later, for $3.89 million. So $1.1 million in value gain. And this is a particularly spectacular product. But I remember when this launched, everyone laughing at the prices. But anybody who bought there did incredibly well, obviously. So $1.1 million, you're looking at 40% over 4 years. 8.6% compounding annually. So back to the equity question, stocks versus real estate. The argument here is leverage, right? Now, I invest in stocks. I've got some uranium. I've got some REITs, right? I like to be diversified. Down payment for an investment property is currently 20%. I think that might change in the future, but currently it's 20% down. So your investment is effectively leveraged 5-to-1 on real property. Whereas in the S&P, obviously, unless you're buying options, you're not levered. So if we were to have put 30K into the S&P 500, specifically into the derivative SPY, back in August of 1996, you would have $201,592 today, which is a fantastic return. Obviously, it's been a good couple decades for the S&P. And that's assuming you didn't panic sell through any of these dips, right? So I actually think that's a slight advantage to real estate, is the low level of liquidity, at least for people with low levels of discipline like myself. I like the fact that you can't just hit the sell button and exit your position, right? You have to really think about it before you decide to do something like that, especially with the transaction fees in real estate. Now, if you had bought a condo in 1996 with the same $30,000 down, right? So 20% down on the average condo back then. The average condo back then was $134,520. You'd be looking at a $586,000 return today instead of a $201,000 return. And that doesn't account for any positive cash flow or any principal recapture. Now, obviously, you've been holding this condo for over 20 years now, so 25 years. So you'd have a ton of principal recapture and a little bit of positive cash flow on that property as well. So, the trade-off is lower liquidity. But with real estate also, you're leveraging and there's more uses for it, right? So one of the most common use cases I have for people buying pre-construction these days is they're buying for their kids, right? They're buying to hedge against their kids' future. They're not sure if they don't want their kids to be renters for life. And obviously prices continue to accelerate. There may be pullbacks along the way, but you extend out long enough. And I think, 5-6% a year, that's what we've seen for the last 50 years. I don't see any reason why that can't continue, especially if we continue to underbuild. So let's talk about pre-construction pricing. As I alluded to earlier, pre-construction is more expensive than resale. How much more expensive? It varies by project. Anywhere from 10 to 30% more expensive, depending on the location. The more premium locations, the more luxury development, usually the more of a premium you'll see, but also depends on the builder, when they acquired the site, what their cost basis is for the land, and all these variables, right? But average that I see these days at launches is 10 to 20%, with some of the premium locations going as high as 30%. Why is pre-construction more expensive than resale? Well, a couple of reasons. Number one is just margin. So you talk to any developers, you'll find that they're making less money developing condos in Toronto today than they were previously. And that's because development charges continue to go up. So just for fun fact today, the average, on the average condo unit, the government, in development levies, in fees, in parkland levies, in HST, in all these various fees, they take $160,000 per unit. So the government actually often takes more per unit than the developer profits per unit. And you can kind of see the breakdown of the costs here. These costs continue to inflate year over year and tend to inflate quicker than the actual cost of resale. So the replacement cost of housing is appreciating quicker than the actual existing housing stock is. So that's one way to look at it. That's why pre-construction is more expensive than resale. And that's why I tell people waiting on a launch is a particularly bad idea, because this is every launch that happened in Etobicoke from April of 2017 through July of 2021. And you'll notice that the price per square foot for a one-bedroom on launch only went one way. Now, there were pretty good deals. If you looked at something that launched like Valhalla and released some inventory along the way, you'll notice that their price increases did not keep up with new launches in the neighborhood. So you could save yourself $125, $150 a foot by knowing that this inventory even exists. But of course, at this point, it's lingering inventory, it's new release inventory. The builder's not doing marketing. You probably don't hear about it. But you can sign up on my email list and you can get all that good stuff. We send out good deals frequently that a lot of people aren't focusing on. But anyways, this is why I tell people it's not a good idea to wait for a launch. And, I got a lot of clients when COVID started or mid-COVID when, condo prices had crashed 10, 15%. A lot of clients called me up and said, hey, Jordan, I'd like to add a pre-construction condo to my portfolio. When do you think pre-construction prices are going to follow resale? Meaning, when do you think they're going to correct down 10 to 15%? And I had to tell those people, unfortunately for both of us, they aren't, because the cost of building these things during COVID has not gone down, and land values have not decreased, and hard costs have not decreased. In fact, the cost of construction has increased Therefore, you're not going to see builders back off on pricing. If they can't achieve their 20% profit margin, because you have to remember, a developer, just like you and I, we're not paying these things cash for the most of us anyways. We're levered. We're getting a mortgage. Just like us, developers are out there getting construction debt in order to build the thing. So if they can't hit a minimum 20% profit target, they cannot qualify for those construction loans. So they can't build the thing. So in the event that those margins are no longer achievable, you don't see developers suddenly correct their pricing downwards. You just see them hold the land, sit on the land, and wait until the resale market gets to a place where the development is economically feasible. Now, where's the value in pre-construction? Lately, I have a ton of people coming to me for pre-construction areas like Barrie, Milton, Brampton, Burlington, Hamilton, because they think that's where the value is. I can get a condo pre-construction for cheaper than downtown Toronto. And while that is true, your gross price is going to be lower. Your per square foot price is going to be lower. If you look at the price difference at condo launches over the last 2 years, so start of COVID to now, in those areas, you're going to see huge jumps. So the average price of a new condo at launch in Brampton is now almost $1,100 a foot. That's up 64% from 2 years ago. Newmarket is up 33%. Milton is up 59%. Barrie is up 52%. On average, these Exurb markets are seeing new condo launch prices up 65% because developers can capitalize on all the people who are thinking the same way. Now, the average price per square foot for new condos launched in Toronto in the last 2 years has gone from $1,300 to $1,500 a foot. So you're looking at a 15 to 20% increase in that time period. So new condos in Toronto are up 15, 20%, which is basically the same cost, the same increase that cost has inflated by. And new condos in other areas are up 50 to 60%. So to me, again, I'm just seeing market dislocation here, and I'm saying, well, Toronto is obviously the better value currently relative to these other options, unless you truly believe work from home is here to stay forever, in which case maybe this does make sense to pay almost the same price for a condo in Brampton as a condo in Toronto. And by the way, it's not always the case that you're paying 20 to 30% more than resale. There are good pre-construction deals. This is an example of a unit that just sold at Islington and Bloor on the resale market. It's a 1-bedroom with parking, 475 square, and it sold for $628,000, which works out to over $1,300 a foot. And this was sold in January of 2022. This unit here is a unit my client purchased in November of 2021 at a building right next door by the exact same builder. So built by this, you can even see the floor plan is the same. Rather, the design of the floor plan is the same. The 1A Westerly 2, this unit was purchased pre-construction, closing 2025. My client paid $522 for it. Now, this unit had parking. This unit did not. So you're talking about $40,000, $50,000 difference for parking, not parking. So regardless of how you slice it, my client's in the money on this unit already, and they just purchased it 3 months ago. So the last thing I want to talk about are the what I see as inflationary headwinds for pre-construction pricing in the near future. We have a couple of new policies that are going to notably increase the price of pre-construction condos or the cost to build of them, which obviously is just passed along to the market. Construction costs are up, labor shortages. There's a lot at play here. So profit margins are thinner than they've ever been for condo developers. This is obviously not good. It's why you see condo buildings get canceled. Construction costs are up 20% since fourth quarter of 2019 for high rise and 35% for low rise. I've spoken to developers who have said they're hesitant to even launch because of supply chain issues and labor shortages. That, of course, is a supply constraint and is an issue for pre-construction pricing. Now, we have 2 new policies coming into play here. Thanks to Jeremiah for this tweet. He's a big land assembly guy in Toronto. You've got 2 things. Number 1, inclusionary zoning. And this basically means that moving forward, a certain percentage, 5 to 11% of every condo building in Toronto will be forced to be affordable housing. Now, obviously, that affordable housing portion has to be subsidized. That cost has to be passed along somewhere. And so that'll be passed along to the saleable units. So on average, inclusionary zoning adds $25 to $50 per buildable foot, which can be as high as $100 per saleable foot. And you also have bathtub foundation. So you have a new foundation policy that I don't know very well, but essentially they're projecting that it's going to add 15 to 35 bucks per buildable square foot on condo development. So you add this all together, you get $100 to $150 per saleable square foot pretty easily on any projects that are being zoned 2022 going forward. And here's just kind of a quick graphic from Jeremiah about the inclusionary zoning. So the loss of revenue that you'll see on a project that you launch with inclusionary zoning. So going forward, it's going to be harder to hit those profit margins, and that market, that loss of revenue has to be passed along in the form of higher prices to consumers, to people who are buying condos, because developers aren't just going to build this out of the kindness of their heart. They still have to hit their 20% profit target, and so you're going to see on any new projects that are zoned going forward, you're going to see higher prices than projects that were zoned previous to that. So that's it for today, guys. Thank you for sitting through this long and drawn out fundamentals. If you have any questions, leave them in the comments below, and I will see you guys next week.